Good evening and welcome to today's Market Close Report. Let's start with a quick snapshot of the key numbers. The Nasdaq Composite closed at 25,297 points, down 0.24%. The S&P 500 edged lower by 0.05% to 7,354. The Dow Jones Industrial Average slipped 0.09% to 51,876. The VIX Volatility Index fell 2.54% to 18.41, but that is still an elevated level, indicating market nerves remain on edge. The 10-year Treasury yield declined 0.46% to 4.37%. The dollar index was virtually flat at 101.37, while the offshore yuan held steady around 6.80 against the dollar. In commodities, spot gold was the standout performer today, surging 1.77% to break above the $4,100 level, making it the strongest asset class of the session. West Texas Intermediate crude slipped 0.61% to $70.24. Bitcoin edged up 0.35% to $60,042. Now let's talk about the big picture. Today's market was a textbook case of structural risk-off and divergence. Risk aversion dominated capital flows. Gold hit a fresh stage high, while China's A-share market saw deep corrections, with the Chi-Next index plunging 4.07% and the Shenzhen Component Index falling 3.44%. In contrast, the three major U.S. indexes only posted modest declines, creating a three-layer structure of Asian panic, U.S. resilience, and safe haven demand. Let's walk through the global session. The Asian session started with the shares leading the decline. The Shanghai Composite fell 2.26%, the Shenzhen Component dropped 3.44%, and the Chi-Next Index tumbled 4.07%. Several factors triggered this sell-off. Overnight weakness in U.S. tech stocks, reports that the U.S. plans to tighten export controls on AI chips to China, and China's anti-dumping investigation into optical fiber preforms from the US and Japan all weighed on sentiment. Northbound capital saw significant net outflows as money fled in panic. When we moved to the US session, the three major indexes closed with narrow losses. Tech stocks came under pressure, but defensive sectors showed relative strength. There was no panic selling. Instead, we saw a structural rotation of capital. The key inflection point today came during the Asian session. As the shares accelerated their decline, gold broke above $4,100 and became the emotional leader for the entire day. Comparing this to our forecast from yesterday, we correctly predicted that U.S. stocks would remain range-bound and that Treasury yields would decline. But we clearly underestimated the magnitude of the A-share sell-off and the upside momentum in gold. The biggest surprise was how quickly and violently the market priced in the escalation of U.S.-China tech restrictions. On top of that, concerns about accelerated delisting rules under the new National 9 guidelines added to the pressure, and the market completely ignored the central bank's 150 billion yuan reverse repo operation. Looking at the interplay between currencies, equities, and bonds, the dollar index edged lower and the yuan remained relatively stable. The sharp drop in A shares did not trigger a currency panic, suggesting capital outflows may be under control. In equities, the divergence between a modest U.S. decline and a sharp A share sell-off was huge, reflecting different core concerns in each market. In the bond market, the 10-year Treasury yield declined, trading on a recession plus easing narrative. Overall, we saw a weak resonance of stocks falling and bonds rising, but the currency did not follow the deterioration in risk appetite, creating a small divergence. The capital flow theme was very clear. The strongest direction was gold and precious metals, driven by risk aversion, a weaker dollar, and falling Treasury yields. The weakest direction was China's TMT sector. The Chi-Next and Shenzhen indexes both recorded their largest single-day declines in recent times, driven by tech restrictions, disappointing earnings pre-announcements, and tighter delisting rules. For tomorrow's early session, we expect the Shanghai Composite may extend its decline by 0.3 to 0.8% before finding support around the 4,000-point level. Gold may trade in a volatile range or edge slightly lower, as the breakout above 4,100 invites some profit-taking, but risk aversion and a weak dollar should provide support. The 10-year Treasury yield is expected to trade in a narrow range between 4.35 and 4.4% as the market waits for tomorrow's US PCE inflation data. Here is our strategy recommendation. For tonight through tomorrow morning, we favor a hedging and wait-and-see approach. The market remains in a corrective phase. The panic selling in shares has not shown clear signs of stopping, and the crowding in gold trades is increasing. If tomorrow's US PCE data comes in below expectations and the 10-year yield falls below 4.35%, we could consider a small position in gold ETFs or defensive utility stocks. But if shares continue to plunge more than 2% at the open, we would abandon any long attempts and move to cash. Our probability assessment for tomorrow is 20% up, 35% range-bound, and 45% down. Risks are still being released. Stay disciplined on position sizing and remain cautious.